This video is a summary analysis and concluding trend forecast for gold for 2013. Governments of the world have only ever had one answer to the debt crisis, which is to print money and monetize debt. The next phase of which is what I call the quantum of quantitative easing, as central banks are effectively cancelling government debt as they return interest paid on the debt or bonds back to the government. This spiral acts as an accelerant upon what is an exponential inflation megatrend. Whilst official inflation indices tend to underreport real inflation rates, still they cannot mask the exponential inflation megatrend, as illustrated by this graph, that the Great Recession deflation of 2008 to 2009 amounts to nothing more than a minor blip, a mere ripple on the ocean of inflation that the world's economies are immersed in. Gold and other assets such as stocks tend to be leveraged to the inflation megatrend. However, gold's 10-year bull run of over 300% even after leverage is far beyond CPI inflation of 29%, which suggests that most of the gain is as a consequence of speculative interest rather than inflation that the correction of the past 18 months has sought to unwind and has probably further to run. For the duration of the past 3 years, highly vocal calls have been heard to warn of an always imminent dollar collapse. However, such calls fail to comprehend the fact that all currencies are in a perpetual state of freefall against one another that manifests itself in inflation. This chart shows that gold and the US dollar have a tendency to move in 6-month cycles of being in sync and out of sync with one another. The current cycle suggests another 3 months of synchronicity. Many gold bugs await a bubble price spike similar to that of 1980. However, this graph shows gold has experienced several small spikes spread out over a number of years. This implies that the best moves are now behind gold, and at best gold bugs can expect 4 to 10% per annum, and therefore it is highly unlikely that spikes that gold bugs such as Mark Faber and Jim Rogers constantly suggest will not materialize for many years. Following the August 2012 peak at just over $1,900, gold has repeatedly failed to hold uptrend lines, on break of which the gold price has kept resolving down toward the bottom of what now is an 18-month trading range with support at 1550 and resistance at 1800. This is expected to contain most of the price action during 2013, whilst the current trend is targeting a move to support at 1550. A break above 1800 would target 1900. The MACD indicator is bearish, which implies a continuing downtrend into early 2013. Elliott wave theory suggests that gold completed an ABC correction from August 2011 peak into May 2012 and currently implies an impulse wave 3 rally to new all-time highs, so is bullish. However, this is contrary to the sum of this analysis and therefore is not giving a reliable probability for actually materializing, so Elliott wave will be ignored, as I'm sure an alternative count will become clear with the benefit of hindsight. Gold has not had a down year for 12 years now. Add to that expectations of a trading range of 1800 to 1550 for 2013 and the last close of 1660 which suggests that gold has a 40% probability for a down year, and even more so should gold actually rally from here into year end. Which is cheaper, gold or silver? On face value, the gold-silver ratio implies silver is significantly cheaper than gold. However, silver is heavily dependent upon sentiment, i.e. it needs a strong trend to be underway to outperform gold. Therefore, expectations of a gold trading range implies that while silver is cheap, it could yet get cheaper, especially at the bottom of gold's trading range. Alternatively, should gold break out above 1800, then silver will be expected to outperform. This supports a strategy of accumulating silver towards the bottom of gold's trading range. The bottom line is that whilst the gold bull market will likely continue until ZIRP ends, however, the best years of gains are now probably behind gold, as gold is now in a mature bull market that is unlikely to see gains of more than 10% per annum at best. Therefore, my forecast conclusions for 2013 are to expect gold to trade within a trading range for most of the year of between 1550 and 1800, all the way into the year-end close of about 1760, with a 40% chance of a down year. The risks to the forecast are if gold price breaks out, which would first target 1900.